So the last of the 5 characteristics that we'll look at is flexible coverage. Now, to be fair, this is probably the most complex part of an already complex product. I'll do my best job of explaining it, and hopefully you're with me. You may have to watch this section once or twice. This is the section that I find students, probably out of all of the material we cover in the whole course, this is the section where I find that most students have the most difficulty. So, the 4 different death benefit options that are available with a universal life policy. If we can think back to our bucket for a second, and remember we had this account value. So I hope that you agree with me that if we pay money into the policy, we take out our cost of insurance and our expenses, and then there's some money left, that we should get some growth here, probably if the investments are proper and we have enough time. So over time, we might get some investment growth that looks like so. Now, we're going to compare this investment growth to the actual death benefit that will be paid by the universal life policy. So I'm going to start with the 2 most basic structures for a death benefit. We're going to look at 2 slightly more complex structures in a minute. The first we're going to look at is a straightforward, easy to understand level death benefit, and the other that we're going to look at in the first batch is what we call a level death benefit plus the total account value. So the level death benefit, if we assume that we're going to have this growth like so, and maybe the same thing over here, we have this growth. In a level death benefit structure, if you purchase a $250,000 universal life policy, for example, then you know that as long as you own the policy, the least your death benefit can be is $250,000. In theory, at some point, this account value could grow to exceed $250,000. If that happens, then that becomes your new death benefit. So with a level death benefit structure, your death benefit is going to be at least the face value that you purchased, but if your account value should grow to exceed the face value, then that will become your new death benefit. And that is a relatively straightforward structure. That is also the cost of insurance, the coverage option that results in the lowest cost of insurance. So if you're looking to keep costs down, you might use a level death benefit structure. It's the least expensive of the 4 choices that I'm going to show you, because it's going to result in most cases in the lowest death benefit between the 4 options. If you have a level plus total account value policy, what happens, you purchase the policy at a certain face value, you have this account value that grows as you own the policy. The difference between this and the level structure is that those 2 amounts will grow together now. So every dollar of accumulation in your account value represents an extra dollar added to your face value. So if you have a client who dies with a $250,000 face value and they have $100,000 in their account value, the death benefit with the level plus total account value is the $250 plus the $100. This person would die leaving a $350,000 death benefit. That same scenario with the level structure would result in only a $250,000 death benefit. The $100,000 would not contribute to the death benefit in that case. So those are the 2 most basic structures. The level plus total account value, because it typically represents the highest risk for the insurance company, you'll notice that here the insurance company's risk never changes. The insurance company is always going to have to come up with $250,000 no matter how much account value you've accumulated at the time of death. Because of that, this is the most expensive of the 4 death benefit options that we will look at. Whereas the level structure is going to see the insurance company's risk actually decrease. And at this point, when you have an account value that's equal to the face value of the policy, the insurance company has no more risk. We could also have a level death benefit that would be indexed Or we could have a level death benefit plus cumulative gross premiums. An indexed death benefit looks very much like the level death benefit. So again, if we can use the same picture here roughly, what you'll see with the indexed death benefit, instead of having a level face value, the face value is going to see scheduled increases to keep pace with inflation. So you might see a 1.5% or 2 or 3% increase every year, depending what inflation is. Face value increases. It's only slightly more expensive, but it is a little more expensive than the level death benefit option, only because you have more death benefit here. Again, like with the level option, if your account value grows to a point that it exceeds what your face value is at that point, that will become the new death benefit. And then, with level plus cumulative gross premiums, this one is one that people have a little bit of difficulty with. Again, if we can use that same picture, what would happen here? Let's say that we have a $250,000 face value, and we're paying premiums of $2,000 a year. The first time you pay that $2,000 premium, we would add that. It's cumulative gross premiums. Cumulative means constantly adding. Gross means the total amount. And premium means how much you're putting into the policy. We sometimes refer to that as cumulative gross deposits. Same thing. So as soon as you pay a premium here, it's going to increase the death benefit. The death benefit based on a $250,000 face value and a $2,000 premium is going to be $252,000. And then next year, assuming you pay the same premium, it would be $254,000. And then $256,000. And then $258,000. If you paid a higher premium, it would result in a larger increase. A lower premium would result in less growth in that death benefit. So this option keeps the insurance company's risk fairly high. The insurance company always faces a fair amount of risk here, and as a result, this is the second most expensive death benefit option. So at this point, we've looked at flexible premiums. We can see that as the policy owner, you have the ability to manipulate the premiums paid. Even one step further here, if you have a good account value built up in your policy and you fail to put more money in, so you stop putting more money in, the insurance company will use what looks very much like the automatic premium loan option. They're just going to take the money right out of the account value to pay your expenses and your cost of insurance. And for some people, this is their goal with their universal life insurance, to have built up so much value here that they're going to get more growth than the amount the insurance company takes out to pay the cost of insurance and expenses. And this is realistic. Some people get their universal life policies to that level. We've seen flexible coverage, 4 different death benefit options. This is where it gets tricky, though, determining who should acquire what type of life insurance policy. Assuming we have a client who's going to be somewhat investment-oriented and seeking some flexibility and is going to actually manage their policy, we now have to decide what type of death benefit is most appropriate for them and which of the funding options, whether a level or a YRT cost of insurance, is more appropriate. Now, we talked about that decision a little bit a few minutes ago, but I'd also like to talk about what leads people to each of these. So normally, where you have somebody who's trying to keep their costs in control, maybe so that they can maximize their investments, you're typically going to go to one of the less expensive options, maybe the level or maybe the level indexed option. If you have somebody who's maybe in their 30s or 40s, has a family already, and is buying the universal life insurance primarily for the purpose of building protection in case of their untimely departure, then you're typically going to go to a level plus total account value. And that's generally what you'll find, is people who are in that family type of situation will often choose level plus total account value. When business owners acquire universal life insurance, when a business buys universal life insurance on somebody within the business, it's not uncommon to use the level plus cumulative gross premiums option, because what happens then is that at the point where we have a death of the life insured, the business knows that whatever it put into the policy, it's going to get back out of the policy. This can help to manage some tax complications that can arise that are really beyond the scope of this course. It also allows the business to know for sure that whatever money they put in, they get back out, which keeps accounting clean typically. Then we move on to flexible investments. We already talked about this in some detail, that there are a number of investment options available. You'll find some insurers that offer hundreds of investment options within their universal life policies, and some that offer a fairly basic selection of investment options. The product is consumer accountable, so we said the consumer has to be the one to make decisions about how the universal life policy is going to work. And finally, it is a transparent or unbundled product, meaning that the consumer can see everything that's happening. They're going to get regular statements that are going to compel them to have a look at those statements and decide whether they want to continue down the path they've chosen, or whether they might want to change the amount of premium they're paying, or whether they might want to change their investment structure. Typically with the coverage, we don't have the opportunity to change that once we're in the policy. So universal life insurance is a fairly complex product. There's a fair bit to know, and you will be expected, for the purposes of the exam and in real life afterwards, to be able to assess what kind of universal life insurance policy, or if you're even going to use universal life insurance for a particular client. Keep in mind tax deferred growth or tax exempt growth, which is a powerful characteristic, the ability to borrow against the policy later on, which is useful. We're going to have creditor protection of the account value if you've named the proper beneficiary, which is the same as for whole life. We're going to have the ability to build a death benefit to meet our needs. It's a very good estate planning tool, and used properly, the flexibility from universal life insurance can help a client to meet needs that occur throughout their life cycle. I hope at this point that you understand a little bit better the functioning of universal life insurance. As always, feel free to contact us with questions, and enjoy your continued studies. I hope that you're finding it beneficial, and I hope that you're achieving your aims. Thank you very much.